Are you currently too scared to throw your money into the stock market because people always tell you that it's too risky, you might lose all your money, and that the stock market is very unpredictable? Well, I was in your position about 3 years ago when I first started investing. And I had no one really guiding me through the whole process, which made it all the more scarier. So I was basically tossing my fishing line out into a sea and hoping for the best thing with the companies that I chose. In today's video, my goal is to share with you guys 6 different stocks that I would put in a portfolio if I were to start from scratch today. And this stock portfolio is a low to medium risk portfolio in my point of view because these stocks aren't super volatile, but I did make room for one of the more volatile stocks, which I'll talk about later on. And I think you guys, if you're a beginner investor, don't follow this portfolio to the T, but kind of take the general idea and my thought process as to why I picked these stocks. And right now, looking at the market condition, the reason why I made this portfolio a low to medium risk is because I see there's really high risk with those high volatility stocks, like high tech stocks, Tesla for example, or Amazon, and these stocks are hitting their all-time highs, and the GDP doesn't really reflect what these companies' valuations should be. And for this reason, I'm picking a more defensive portfolio because, who knows what could happen in the next 6 months. So to begin, the first company on this list is TELUS. And really you could substitute any of the 3 big telecom companies in Canada because they're all relatively stable and they're not going to go bankrupt overnight. And the purpose for choosing TELUS is really more for the stability as well as the dividend payout. And right now TELUS pays out a dividend of 4.97%, which is actually quite juicy for the average dividend that we see over time. Typically, as an investor, when we're buying dividend stocks, we purchase dividend stocks in the 2 to 4% range. But because right now the market is still fairly sold off for these telecom companies, we're seeing higher dividend yields. And Bell and Rogers, they have dividend yields of 5.9% as well as 3.58% respectively. And I think either of these plays could be very good. Rogers has a bit more growth, whereas Bell is a bit more stagnant, but they have the largest market share. And I think I lean toward TELUS because of Public Mobile, and this is currently the cell phone carrier that I use, and I'm really a huge fan of this carrier because it allows you to get referrals and save on your monthly plan. And if you're interested in signing up for Public Mobile, I have a link down below in the description. And automatically, if you sign up with AutoPay, you get $2 off your monthly bill. And as well, for each referral that you refer, you get $1 off, and for each year that you're with Public Mobile, you get $1 off, up to a maximum of $5. Whereas with Rogers, their discount carrier is Chatter, and I don't even know what Bell has as a discount carrier. So I think Public Mobile is really grabbing a lot more market share for TELUS as a company, and they're going to be able to profit off this in the long run. And as I mentioned earlier, these stocks are fairly stable and they don't move much in price, especially over the past 5 years. TELUS and Rogers saw single-digit gains in 5 years alone, so basically the price appreciation was non-existent. However, Rogers has seen roughly around a 22% price gain over 5 years, which is lagging behind the general market. But these companies have been consistently paying out dividends and raising their dividends year over year. And I think I would keep telecoms in my portfolio because I think when 5G launches, this is when we're going to see the telecom companies kind of leg up to the next level. So although there was no growth in the past 5 years, I think in the next 3 years or so, when 5G is rolling out, we're going to see a lot more growth in these telecom companies. So I would allocate around 15% of my portfolio towards TELUS or any telecom company because it's relatively stable. And I think that we don't need to go all in for this super safe stock, but it's good to have a small chunk of this portfolio as something very stable and basically the rock of your portfolio. And I think right now at the prices that TELUS is selling at, you're not going to get much better in the next couple of years. It's going to stay around the $21 to $23 level. So I would suggest buying in right around now. And for these telecom companies, because they're so stagnant, it helps you sleep well at night knowing that 20% of your portfolio is not really going to move the next day. But it's not going to drop significantly like we saw back in March where the whole stock market dropped around 30%, with some stocks dropping as far as 60%. And another reason why I chose TELUS over Bell or Rogers is because they're lower price per share. And I think this is attractive for newer investors because you're probably starting out with a portfolio that's smaller, and it's nice to hold a larger number of shares of this company. And I think with a share price of $20 per share, you're able to purchase more shares, and it gives you a bit more freedom to dollar cost average into it, versus Rogers and Bell, which are at $30 and $50 respectively. So the next stock on this list is TD, and TD is in the financial sector. And if you guys haven't already caught on, I'm actually picking stocks in different sectors in the market to spread your risk out a bit more. So TD right now I think is the best bank in Canada to put your money into. And for me personally, I bank with TD as well as do some investing with TD, which is another reason why I invest in this company, because if I'm actually doing my investments and banking with this company, clearly I like the company and the platform, and I'm sure other people do as well. And one reason why I really like TD is because as a client with a mid-sized portfolio, they actually give me a bank account that I don't have to pay any fees versus their closest competitor, which is Royal Bank. But with TD, you have to hold a certain amount within the account such that the bank account becomes free. So for me, I always have a cushion in my bank account and I'm not living paycheck to paycheck, and therefore this account suits me and I don't pay any fees for banking. As well, I get a pretty sweet credit card that comes with basically CAA insurance. And TD pays a solid dividend of 5.12%, which is a lot higher than the previous dividend yields that we've seen in the past, where it's usually been anywhere from 3.5% to 4.5%, as well as it's 22% down from its all-time highs. So I think we're actually getting this bank at a discount right now. And what I really love about TD is because they're actually expanding into the US. And the US is a massive market for banking compared to the Canadian sector. With 360 million people in the US versus around 36 million people in Canada or so, we're seeing that the US is 10 times larger in terms of a market size versus Canada, which means a lot more growth ahead for TD. And for me, because I love TD as a company, and I think banking is basically a backbone of the entire economy, I would put around 25% of my portfolio into TD if I were to invest in it today. I wouldn't actually go right away and put 25% in just right now, but I would dollar cost average over maybe a period of 3 to 4 months and continue averaging in as I do monthly contributions into this portfolio. Right now, my price target for TD, if I were to buy it on the TSX Stock Exchange, would be anywhere from the high 50s to low 60s. And if it ever drops below $40 per share, I would buy in heavy. And the reason why I think Canadian banks are relatively safe from all this tech innovation that we're seeing in the US is because Canadian banking is a lot more heavily regulated versus US, and as well as the fintech revolution in Canada is still a lot further behind than in America. So I see Canadian banks being a bit more safer than American banks right now from the whole fintech revolution. And I think TD Bank itself has actually been evolving its own platform to become a bit more like a fintech company and seeing the needs of its customers from a tech company standpoint. The next stock on this list is Loblaws, and Loblaws can be in the sector of food and entertainment, as well as consumer staples. I really like to think of Loblaws more as a consumer staples because ultimately what they're selling consumers need in their lives every single day. It's not like consumers can live without food or without toiletry or other hygiene products. They literally need these every single day. And currently Loblaws pays a 1.8% dividend, so not very high compared to our telecoms and our financial companies. However, the dividend has been growing steadily since 2013, which is a good sign. And I actually have a question for you guys. If you guys know any good sites that actually do screening on Canadian stocks and show the dividend growth of Canadian companies, I would love to hear that in the comments down below. So Loblaws is actually one of the largest food retailers within Canada today. They own chains like Zehrs, Superstore, Shoppers Drug Mart, No Frills, and a few other ones that I'm not going to name here. And I've heard good things about Loblaws in the digital innovation space, where they've done things like curbside pickup, online grocery ordering, as well as grocery delivery. And I think as they go forward with these things put in place, it's going to make them a lot more defensive when big tech companies want to come in, where they want to take over the grocery delivery business. In Loblaws, at the beginning of this whole pandemic, they actually saw some price appreciation because investors realized they're one of the only stores that are able to open, and people are shifting their habits from going out and dining and going to buy food from grocery stores. So there's a lot more grocery sales happening in the month of April and May, so therefore Loblaws stock actually shot up. However, it's actually come down as society has continued to open up slowly. And I think that going forward, even though the society has opened up, consumer behavior is shifting a bit away from dining out and doing a bit more cooking in, or maybe just buying more prepackaged food from the grocery stores. So I think Loblaws has some good price appreciation ahead of it, as well as right now it's paying a solid dividend and it's going to be able to grow that dividend year over year. And personally, if I were to put this in my portfolio, I would target around 20% of my portfolio in Loblaws. And looking at the recent prices and how the price action has been moving, I think a solid price to buy in is anywhere from $65 to $70 per share. So right now the prices trade around 71 today, so I'd wait for a little bit for the stock to drop because we do see some volatility on the chart if we look over 1 year. The next stock on this list is Canadian Apartment Properties, ticker symbol CAR, and this is a REIT, or Real Estate Investment Trust. And what this REIT focuses on is mainly apartment rentals and townhouse rentals in more urban areas, and they have a huge presence in Toronto. And I think what I love about this REIT is because of their growth over the past 5 years, especially with the real estate boom in Canada. If you guys haven't seen Canada's population charts, they're actually growing year over year with the whole influx of immigration. I think Trudeau as president has actually allowed a lot more immigrants to flow into Canada. And what this has done for real estate is just made the prices go up. In real estate being an essential for living because everyone needs shelter, people, if they can't buy, they're going to be renting. And I think because real estate markets are very hot all over Canada right now, especially in southern Ontario, we see a lot more people looking to rent because they can't afford to buy. And with property prices increasing as well as rental being more in demand, this is a recipe for success for Canadian apartment properties. Currently, this REIT pays around a 2.85% dividend, which is not very high compared to other REITs. But the reason why other REITs pay such high dividends is because they didn't see much stock price appreciation, which CAR actually saw quite a bit of stock price appreciation. I think anywhere from 100 to 200% appreciation over the past 5 years just because of the real estate price appreciation. So with apartment rentals being basically the largest chunk of their portfolio, they've had a fairly defensive stock price against this whole COVID situation because commercial real estate got hit very hard as companies were struggling to pay rent and they were going out of business. However, for consumers or the everyday resident who actually needs shelter, they can't afford not to pay rent, as well as the government stimulus checks help people to pay their rent out. So we didn't see too much of a price drop in this stock here. And personally, if I were to add this to a brand new portfolio, I would put around 15% of my portfolio into the stock because I think over the long run, it has some good price appreciation due to real estate continuing to go up and up and up in Canada, as well as the dividend will continue to grow. And overall, I see this stock as a win-win in the next 10 years. The fifth stock on this list is WELL Health Technologies. And I've actually done a video on WELL Health before, so you can check that out in the description down below or up here, which I'll post a link there. And WELL Health Technologies, what they are is a technology company in the healthcare space. And they create a product called an EMR, or electronic medical record. And what this does is basically replace all those huge filing cabinets that you see or bookshelves with patient files and put it all into a computer. And this is a very revolutionary technology for healthcare industry because the industry is so regulated that tech has been having a lot of trouble penetrating into it. However, EMRs have come into the market right now and are gaining a lot more traction with doctors within Canada. And I think this company is a very good company to invest in, but it is a bit more of a speculative play because they're a very small cap company and they are at risk because bigger fish can come along and invest millions or even billions of dollars to try to take out WELL. However, I think WELL Technologies is actually positioned very well in the market as they are currently the third largest EMR provider out there, as well as they own their own clinics and they are the fourth largest clinic in Canada, with around 20 to 30 clinics out there, and they actually hold the largest number of clinics within BC. So I think WELL Health Technologies already being such a dominant player in the EMR space, as well as the health clinic space, I think they're going to continue to grow and be able to capture more market share before bigger players come along and wipe them out. And if anything, they are a target for acquisition, which for investors, we will probably see a pretty healthy return of anywhere from 50 to 100% in the next 5 years. But being a speculative play, there is a downside to this company that they could get wiped out. And for this reason, I would only allocate around 5% of the portfolio to this higher risk company. So if this company does go bust, we're only losing 5% of the portfolio. However, if we see tremendous gains, anywhere from 10 to 20x, the value of the stock could actually end up being the value of the portfolio today, anywhere from 5 to 10 years down the road. And I've done a lot of research into this company, and the balance sheet is great, management is great, and the product is great overall. I think this company is poised for success over the long run. And if you guys want to learn more about the stock, definitely check out that video that I mentioned before. And currently at the price of around $3.15 today, I would probably wait off till the stock comes down to around a $3 level before starting to average in. And really, I wouldn't be buying this stock heavily at $3, but I would wait till maybe the stock comes down to around $2.40 or $2.50 before completing that 5% allocation in this portfolio. And with this stock being so small in market cap, there's a lot of volatility in the stock, and we can expect the price to swing over time. And if you're looking for other suggestions other than WELL Health Technologies, you can look at stocks like Kinaxis, Docebo, or even Enghouse as alternatives to the stock and make it your 5% spec play, because the technology sector is a little bit more volatile and you never know, these tech companies can go boom or bust within a year or so if a better player comes along and takes away a lot more market share. And lastly on this list, we have Algonquin Utilities and Power Corp. And this company is in the utility sector, which is also a very safe sector out there. Utilities are fairly heavily regulated. However, Algonquin Power Corp also plays in the renewable energy space, which is a lot less regulated compared to the traditional methods of generating power, such as coal, natural gas, or even nuclear power. And I think that Algonquin being in the renewable energy space has actually got a great tailwind in their favor, because a lot of governments are really promoting renewable energies out there, and they're really giving heavy discounts and sort of government grants to these companies to be developing renewable energy methods out there. And I think eventually we're going to see a larger shift into renewable energies, which is great for Algonquin. And we can see this has rewarded investors who had got in 5 years ago, where the stock price was around $10 and today it's around $70. So we saw about a 70% price appreciation in the 5-year span. However, if you look at the general utility sector, you're not going to see as great of a price appreciation for these shares because they don't have the tailwind of renewable energies, which is what's really getting investors excited about this company right now. And currently this company pays out around a 4.71% dividend, which is very solid for a company that is also considered in my mind a growth company. And I think I would allocate around 20% of my portfolio into this company because it pays a reliable dividend, and as well right now it's down around 20% from its all-time highs. And if I were to look for a position to enter the stock, I think right now at the $17 to $18 level is a very good price to enter in because it's come down 20% from its all-time highs and it's paying a 4.71% dividend on this cost basis at around $7.98 today. And if the stock does drop below $15, I would really load the boat on the stock and maybe even push this up to a 30% portfolio allocation, because I'm very confident in this company to be able to execute over the next 10 years and gaining a lot more market share with the renewable energy strategy. So to recap for this video, the stocks that I would purchase are TELUS at 15%, TD at 25%, WELL Health at 5%, Loblaws at 20%, Canadian Apartment Properties at 15%, and Algonquin Power Corp at 20%. If you guys enjoyed this video or learned something new, please smash that thumbs up button, as well as subscribe and click that notification bell for more videos from my channel. And leave any comments down below about these stocks that you have, or if you own them at all, let me know down below as well. Keep up the grind and have a great day.